Alliant Energy Q2 2026. So a slight miss on the bottom line. JAP earnings per share came in at 65 cents, which misses consensus estimates by a couple of pennies and is down from 68 cents a year ago.
Right.
Total revenue hit $971 million. But despite that Q2 EPS dip, management held totally firm on their outlook. They explicitly reaffirmed their full-year ongoing earnings guidance of $3.36 to $3.46 per share.
Yeah, and signaled they expect to land in the upper half of that range, actually.
Exactly. And the stock traded relatively flat on the news. I mean, it's digesting a quarter that looks a little messy on the surface, but masks a massive structural pivot. So if you're tuning in, you are joining a deep dive into Alliant Energy's Q2 earnings report and their underlying financial disclosures. We're looking at an apparent paradox here.
A pretty big paradox, right?
How is a regulated Midwestern utility managing a projected 60% load growth fueled by big tech, while simultaneously navigating this near-term margin compression?
Well, the divergence between that Q2 print and the full-year reaffirmation, it really comes down to the timing of capital deployment versus expense recognition.
Okay, break that down for us.
So looking at the variance analysis, right? The transition from last year's 68 cents to this quarter's 65 cents is driven by a series of front-loaded hits. The most significant drag was an 11-cent per share negative impact from higher operation and maintenance expenses.
11 cents is a decent chunk. What's driving that O&M spike?
When you look at the subcomponents, you see higher labor costs, increased electric distribution costs, and generation costs tied to planned maintenance activities. I mean, they're actively integrating new energy resources into the grid.
Right.
And that requires upfront operational spend before those assets are fully optimized and, actually contributing to the bottom line.
It's like taking a temporary loss because you're remodeling the store. But we also have to factor in the 7-cent hit from higher financing expenses, right?
Yeah, absolutely. Given the macro environment and just the sheer volume of capital they're raising to fund this expansion, an elevated interest expense is mathematically unavoidable in the short term.
For sure. And beyond that, the disclosures outline a 5-cent hit from the timing of income tax expense. And this is the classic utility excuse, another 5-cent drag from weather.
Oh, the weather variance. Always a factor.
Always. The volumetric data here is super specific, though. Cooling degree days in Cedar Rapids, Iowa, dropped from 313 last year to just 262 this year.
Wow, that's a big drop.
Yeah, and Madison, Wisconsin saw a similar decline. In these service territories that don't have full weather normalization or revenue decoupling mechanisms in place, fewer cooling degree days just means lower volumetric sales.
Right, and that variance flows straight to the bottom line.
Exactly.
But, the weather and the tax timing are transient variables. The financing and O&M costs, those reflect the operational friction of scaling up. But the counterweight to all of this, and really the reason management remains so confident in that upper half of their full-year guidance, is this massive 18-cent per share positive driver.
The silver lining.
Right. It's stemming from higher revenue requirements related to capital investments. This is coming directly from their Interstate Power and Light and Wisconsin Power and Light subsidiaries.
So the rate base is expanding.
Exactly. When we look at the core equation for utility earnings, the revenue requirement equals operating expenses plus depreciation plus taxes plus a guaranteed rate of return multiplied by the rate base.
Right. Finance 101 for utilities.
Yeah. As they finalize these capital projects and those assets go into service, the rate base expands. So that 18-cent boost, it indicates that their recent rate case outcomes and their capital deployment strategies are translating into authorized returns exactly as modeled.
Which means the mechanism of turning capital expenditure into rate base growth is actually functioning. And honestly, it needs to, because the scale of the capital they're preparing to deploy is pretty unprecedented for this region.
Unprecedented is the right word.
Yeah. The most critical data point in this entire earnings presentation isn't the Q2 variance. It is the demand forecast. I mean, Alliant is projecting a roughly 60% increase in customer demand by 2031 compared to 2025 levels.
60%. It's staggering.
But just for context, historical utility load growth models in the U.S., they typically project like a 1 to 2% annual increase, right? Just driven by slow population drift and gradual electrification. A 60% load growth implies a fundamental rewiring of their generation dispatch and their transmission topology.
Yeah, and putting megawatts to that percentage. What's fascinating here is Alliance base maximum demand in 2025 sits at approximately 5.5 gigawatts. They are now projecting the addition of 3.4 gigawatts of total contracted demand to that base over the next 5 to 6 years.
Adding more than half of your existing capacity.
Right, and doing that requires navigating severe physical constraints. You're not just throwing up some solar panels, you're upgrading substations, expanding high voltage transmission corridors, managing this massive interconnection queue.
And the load profile is different too.
Exactly. The load profile of this new demand changes how the utility operates. We
Well,
are talking about data centers. Unlike residential load, which, peaks in the early evening when people get home and then drops overnight.
right, the classic duck curve.
Exactly. But a hyperscale data center operates with a 90 to 95% load factor. It draws massive, constant baseload power 24 hours a day. So the utility has to secure generation assets that can run continuously without interruption.
And the disclosures detail exactly who is driving this baseload demand, which is great because it's not just some abstract forecast.
Right, we actually have names.
Yeah. Meta recently received written approval from the Public Service Commission of Wisconsin for an individual customer rate for a facility in Beaver Dam.
That bespoke tariff structure is so critical.
It really is. I mean, an individual customer rate ensures that the massive infrastructure upgrades required to serve a single hyperscaler are paid for by that hyperscaler. It insulates everyday residential ratepayers from basically subsidizing big tech's expansion.
Right, which regulators obviously love.
Oh, for sure. We also see QTS data centers amending their agreements to accelerate their load ramp in both Cedar Rapids and Clinton, Iowa. And Alliant just announced a newly signed electric service agreement for another 370 megawatts in Iowa, scheduled to reach full ramp by the end of 2030.
So they're locking these guys in, and the transition from projected load to energized load is actively happening right now.
Yeah. Are these companies just reserving space in line, or is this power actually flowing?
The power is flowing. The Q2 highlights specifically note that Google has already energized its transmission in Cedar Rapids and is beginning to ramp up its contracted energy loads.
Oh, wow. Okay.
Yeah, the market often discounts long-term demand projections because interconnection queues are notorious for vaporware, right?
Sure.
Projects that secure a place in line but never secure financing.
Right, just placeholders.
Exactly. But Google pulling physical power from the grid today, combined with QTS aggressively pulling forward their load ramp schedules, it demonstrates that this 3.4 gigawatt pipeline has an unusually high probability of realization. The urgency from these hyperscalers is forcing the utility to compress a decade's worth of infrastructure development into a 5-year window.
Which brings us to the balance sheet implications. Because if you have to increase your power generation by 60% in 5 years, how on earth do you pay for it without destroying your balance sheet?
That is the multi-billion-dollar question.
Literally. Funding that expansion requires a monumental capital expenditure plan. Alliant has outlined a $13.4 billion CapEx program running from 2026 through 2029.
$13.4 billion.
Yeah, that represents a compound annual growth rate in investments of roughly 12%. And when you consider that their current net property, plant, and equipment on the balance sheet is around $21 billion.
They're spending more than half their current asset value in 48 months.
Exactly. So the immediate concern for any retail investor or equity analyst looking at a $13.4 billion CapEx plan is dilution. Utilities generally fund CapEx with a 50-50 mix of debt and equity just to maintain their investment-grade credit ratings. So if they have to issue massive blocks of new shares to fund that equity portion, that dilutes existing shareholders, right? It drags down EPS until the new assets start generating returns. Should investors be worried here?
I mean, dilution risk is the primary headwind for any high-growth utility thesis. But Alliant determined they need to raise approximately $2.4 billion in equity to support that $13.4 billion CapEx plan. However, they have structurally de-risked the execution of this raise.
Okay, how so?
They aren't relying on spot market secondary offerings, which can be super volatile. They've already addressed roughly 75% of that $2.4 billion requirement through executed forward contracts under their at-the-market or ATM program.
The mechanics of those forward contracts are vital to understand here. Because when a company executes a forward contract, they essentially agree with a counterparty to sell a specific number of shares at today's market price.
Right.
But the actual settlement, like the exchange of shares for cash, is deferred to a future date.
Exactly. And that allows Alliant to lock in their cost of equity based on current valuations. It completely neutralizes the risk of a market downturn over the next 2 years.
Which is huge.
And more importantly, they don't issue the shares immediately, which means the share count in the EPS denominator doesn't artificially inflate until they actually draw down the cash.
Ah, so they match the physical equity issuance to the exact moment they need the capital to pay for the infrastructure.
Exactly. It optimizes EPS accretion. By locking in $1.8 billion in forward contracts, which are primarily slated for settlement in the second half of 2026 through 2028, and combining that with their dividend reinvestment plan, management has reduced their residual equity need to just $500 million through 2029.
Wow, just $500 million left to raise.
Right. It is a highly defensive posture in a hyper-capital intensive cycle. You secure the funding before you ever break ground.
And we actually see that exact same defensive posture applied to their debt financing. The debt schedule in the disclosures highlights the execution of a $300 million interest rate swap.
Oh, yeah, the SOR swap.
Yeah, they effectively swapped the floating MSOFR, the secured overnight financing rate, for a fixed rate of roughly 3.00% through March 2028.
Which is incredibly smart right now.
Right. In an environment where the yield curve has been inverted and short-term floating rates have been so elevated, carrying variable rate term loans just introduces significant earnings volatility. By executing the swap, they convert a floating liability into a fixed predictable cost. When you are managing a $13.4 billion CapEx pipeline, eliminating interest rate variance on your existing term loans just allows you to forecast your weighted average cost of capital with so much higher precision.
But, controlling the cost of capital is only effective if the capital can actually be deployed. And that transitions us to the regulatory and macro risks detailed in the forward-looking statements. Having the money and having the customers, that's only 2/3 of the battle for a utility. Securing the load and securing the financing are prerequisites, but the ultimate constraint on this whole 60% growth thesis is the regulatory approval process.
The final boss.
The final box, exactly. It's like having the budget and the blueprints for a mega mansion, but you still have to fight the local zoning board and the HOA for 5 years.
So what's pending on the dockets right now?
To meet that 3.4 gigawatts of baseload demand, Alliant is leaning heavily into natural gas to ensure grid reliability. They have dockets pending for the 720-megawatt Morgan Valley Energy Center and the roughly 1,200-megawatt Riverhawk Energy Center. Both are huge natural gas facilities, and both require certificates of public convenience and necessity from state regulators. We're expecting decisions on these dockets in early to mid-2027.
Okay, 2027. So if those facilities face regulatory delays, or if they face opposition over emission standards or require redesigns, that directly threatens the energized timelines they promise to the data centers.
Exactly. And beyond state-level dockets, the federal regulatory landscape presents structural uncertainties, too. The disclosures specifically flag FERC docket EL24800000.
Right, that is a critical policy debate regarding the interconnection queue right now.
It's massive. The core issue in EL248000 is whether massive interconnection customers like these hyperscale data centers can self-fund network upgrades.
Because historically, network upgrades, like the broader transmission enhancements required to accommodate new generation or load, they are funded by the utility and rolled into the rate base.
Right, allowing the utility to earn a return on that capital.
But if FERC rules that tech giants can simply upfront the capital for these upgrades themselves, it creates a dual dynamic. On one hand, it drastically accelerates the build-out timeline because the data center's deep pockets bypass the utility's financing constraints entirely.
They just write a check.
Exactly. But on the other hand, it removes that capital from the utility's rate base. The utilities still have to operate the upgraded grid, but they don't earn their authorized return on equity on the capital because they didn't deploy it.
And that dynamic fundamentally alters the growth thesis for the stock. If utilities are relegated to merely operating infrastructure that was funded by their largest customers, their earnings growth trajectory totally flattens.
That makes sense.
Yeah. And the disclosures also detail supply chain and macroeconomic vulnerabilities. Tariffs are a prominent variable, specifically regarding solar project materials. The imposition of anti-dumping and countervailing duties, or AD/CVD, on solar cells and modules from Southeast Asia fundamentally alters the levelized cost of energy for planned renewable projects.
Right, and just to be clear for you listening, we're not taking a stance on the politics of trade or tariffs here, just reporting what's in the disclosures. If variable costs on solar procurement spike due to tariff enforcement, The utility either has to absorb the cost overrun or attempt to pass it through to ratepayers.
And passing it through faces immense friction at the Public Utility Commission level.
Exactly. And underlying all of this infrastructure build-out is cancellation risk. Alliant is planning to deploy $13.4 billion, largely based on the projections of the AI and cloud computing sectors. The contracts with Meta, Google, and QTS are robust, but if the broader macroeconomic environment forces a contraction in tech spending.
Or if advancements in chip architecture suddenly make data centers vastly more power efficient.
Right. The projected 3.4 gigawatts of demand could just evaporate. And if a utility builds gigawatts of baseload natural gas and transmission capacity, and the anticipated load fails to materialize, they are left holding stranded assets. Regulators are historically very hesitant to allow utilities to recover the costs of overbuilt, underutilized assets from everyday residential ratepayers.
But the mitigation of that stranded asset risk is precisely why we see mechanisms like the individual customer rate in Wisconsin. Utilities are demanding heavier financial guarantees, minimum take-or-pay contracts, and significant upfront capital contributions from the tech companies before they even break ground on these mega projects.
Right, making tech have skin in the game.
Exactly. Management is essentially attempting to execute a transformation from a traditional, slow and steady yield-focused utility into a high-growth infrastructure developer. But they're doing this while maintaining their commitment to income investors. They explicitly reaffirmed their 2026 dividend target of $2.14 per share.
So navigating the execution of the CapEx plan, the regulatory approvals, and the physical supply chain,
Right.
all while maintaining dividend growth and flat equity issuance, it basically requires near-perfect operational execution.
Yeah, the margin for error is razor thin.
So to summarize what we found today, the Q2 print showed a minor EPS miss driven by front-loaded O&M and some transient weather impacts, but the underlying rate-based growth remains firmly intact. The core thesis here rests on a projected 60% load growth by 2031, demanding 3.4 gigawatts of new capacity primarily for big tech data centers. Alliant is answering this demand with a $13.4 billion CapEx plan, having proactively neutralized near-term dilution risk by locking in $1.8 billion in ATM forward equity contracts. However, the realization of this growth is entirely contingent on navigating state-level approvals for massive natural gas facilities, federal FERC decisions on grid funding, and global supply chain tariff risks.
And as we monitor this capital deployment cycle, a broader structural question emerges regarding the future of the power sector itself.
Oh, right.
Think about it. The hyperscalers, Google, Meta, Amazon, they possess balance sheets that dwarf those of regulated utilities. And their demand for uninterrupted massive-scale power is accelerating faster than the traditional regulatory framework can process.
That's very true.
So if regulatory friction, interconnection queue delays, or supply chain bottlenecks prevent utilities from delivering this 3.4 gigawatts of capacity on the tech industry's timeline, the whole dynamic shifts. We may see these hyperscalers increasingly turn to behind-the-meter generation, microgrids, or direct investments in small modular reactors.
Effectively bypassing the regulated utility model to become independent power producers themselves.
Exactly. As big tech races to build AI infrastructure, the ultimate bottleneck might not be microchips or code, but physical electricity in places like Iowa and Wisconsin.
That is a wild thought to leave off on.
Yeah.
We will definitely be tracking those regulatory dockets and the forward contract settlements closely in the coming quarters. Thank you for joining us for this deep dive. If you want to keep up with the structural shifts happening beneath the surface of these earnings reports, be sure to follow the show for our daily earnings coverage, where we will continue to break down the fundamentals driving the market. Catch you next time.